Brad Williams, Frugal Finance. Swaps, the parallel loan. How swaps began. Today, there are no officially imposed restrictions on the movement of most major currencies. In the not too recent past, central banks in many industrialized countries imposed active restrictions on the flow of currency. The parallel loan market developed to circumvent restrictions imposed by the Bank of England on the free flow of British pounds. British firms wishing to invest abroad generally needed to convert pounds into US dollars. The Bank of England required these firms to buy dollars at an exchange rate above the market price. The purpose of this policy was to defend the value of the pound in terms of other currencies. Firms weren't keen on footing the bill for the Bank of England by shelling out more money than market rates for the dollar it needed as per its policy. Trying to dodge these currency controls is what spurred the growth of the currency swaps market. Think about two similar firms, one American and one British, each with operating subsidiaries in both countries. Assume that the free market value of the pound would be $1 to $160. That means 1 British pound equals $1.60 US. And that the officially required exchange rate for British firms to acquire dollars equals 1 pound equals 144. That's a heck of a haircut. In this environment, the British firm would like to exploit an investment opportunity in the United States that required an outlay of $100 million. The free market value of the needed $100 million is $62.5 million. 100 million divided by 1.6. If the British firm complies with the Bank of England's regulations, it will have to pay pounds of 69,44444, one too many fours, for the needed dollars. 1 million divided by 144. From the firm's point of view, this regulation will require the firm to pay a subsidy of almost $1 million. By cooperating with a U.S. firm that has operations in England, the firm can evade the currency controls. The British firm lends pounds to the U.S. subsidiary operating in England, while the U.S. firm lends a similar amount to the British subsidiary operating in the United States. This is a parallel loan. Two multinational firms lend each other equivalent amounts of two different currencies on equivalent terms in two countries. A parallel loan is also known as a back-to-back loan. Let us suppose that the U.S. subsidiary of the British firm borrows $100 million from the parent of the U.S. firm for 5 years at 1 year U.S. SOFR, while the British subsidiary of the U.S. firm borrows pounds 62.5 million from the British parent for 5 years at a fixed rate of 7% interest. Figure 22.1 shows the cash flows from this perspective of the British firm, integrating the cash flows of the British parent and subsidiary. These are exactly the cash flows from a plain vanilla received fixed currency swap. In creating this parallel loan, the British firm will be careful to record these loans as two unrelated transactions, keeping the Bank of England in the dark. In this example, the British firm got the free market exchange rate. In practice, the U.S. and British firms might share the gains from evading the currency controls by an exchange rate value of the pound between 144 and 160. Alternatively, the two firms might share the gains from currency evasion by having the U.S. firms pay a fixed rate that is somewhat lower. The inception of swaps can be traced back to the desire to establish parallel loans. While the expected cash flows from both the parallel loan and standard currency swap may seem identical, subtle yet crucial distinctions exist. In a parallel loan, both parties must maintain the facade that the transactions are entirely separate. This means that defaulting on one loan wouldn't validate default on the other party's loan. On the contrary, in an interest rate swap agreement, cross-default clauses are included. These clauses cannot be part of the parallel loan since both parties aim to portray the loans as distinct. Additionally, a swap agreement typically incurs lower transaction costs compared to arranging two separate loans. Brad Williams, Frugal Finance. See you soon.